In this video, I'm going to explain what a cap rate is and how you can use it in a very practical way to analyze real estate investments. I'm also going to share a bonus lesson with a slightly different formula that I've actually used a lot more over the last 18 years as a real estate investor to analyze my own properties. And I think you'll find it helpful too. We're getting started right now. The cap rate is short for capitalization rate, and it's just a ratio of two important things in real estate investment. One is the income, the other is the price. So it's a formula that gives you a ratio. Typically it's looked at as a percentage formula, and I'll give you an example in just a second. But the important part to understand here is that ratio, almost like a rate of return when you think about how much money am I getting back from an investment, it's fairly similar to that. It's a specialized type of rate of return. And on the top of this formula is net operating income, also known as NOI. And I'm going to unpack that a little bit more in a second. And then the purchase price. Now there's a couple different ways to look at this, and depending on who you talk to, they might use it in different ways. But in most cases, and myself included, when I'm doing a cap rate and I'm running the formula, I include the upfront closing costs, and I also include the repair cost. Because what you're really trying to understand here is what is the total cost that it takes to operate this property to get it producing income. If it's in most cases, if it's a stabilized property, it's already producing income, those are really not a big issue. But every once in a while, and particularly the types of properties I buy and other investors who are adding value to properties buy, they might need a lot of repairs. And so you might have to put $50,000 into a property, and that's part of the cost that it takes to get this property rented and up and running. So just understand first and foremost, that's the basic formula. If somebody says, what's a cap rate? That's it. But let's unpack a little bit more some of these terms so you can understand what each one is. Because cap rate is a ratio of the income to the price, it's really important to understand what it means by income. Because as you'll find in real estate investing, there's lots of different definitions, lots of different formulas, and the devil is in the details. So let me unpack what net operating income means. You start with the gross rental income. That means the total expected rental income. And then you deduct things like a vacancy or credit loss. And this just takes into account that your property is not always going to be rented. So you might rent the property for $2,000 per month, but what if it's vacant 1 month out of every 2 years in between tenants? Or what if somebody doesn't pay you on time, which is a reality that we all realize at some point in our career. And so you're not going to receive all of your income, and so you want to at least set aside some kind of percentage to take into account vacancy and credit loss. In my case, in a stabilized kind of small residential rental property, it's often about 5%, but it's just going to depend on where you are exactly what that's going to be. The second thing here, property taxes. So your local municipality includes all the things that pay for schools and local property expenses and city expenses and garbage collection, things like that. And then you have property insurance, you have maintenance and repairs. And I'm going to talk about what that is and what that isn't. But your basic maintenance and repairs, definitely things like cutting the grass, if you have common areas that you cut the grass on, other, changing the toilet or fixing different things, water leak, those definitely fall under maintenance and repairs. This also includes utilities. If you pay for like a multi-unit building and you pay for common utilities, or if all the units include water and you pay for that, it would include that. And then it would include other miscellaneous expenses like HOA, licenses, etc. And so when you deduct all of those expenses from the gross rental income, you get your NOI. There's a couple things, important things that are not included in these expenses, which you also want to know about, but it does not include debt payments. So an important part about a cap rate is that it's the ratio of income to price, not looking at debt. So it's one of the helpful things about it is you're able to compare apples with apples, with one property to another without having to consider debt. Because everybody has a little different debt formula. They put a different amount down. They have a different interest rate. And so it can complicate the analysis of the value of a property, which ultimately is what cap rates are used for if you include debt payments. So it does not include debt payments. It also doesn't include something called capital expense repairs. And you can think about these as the larger expenses. So when you replace a roof, when you replace the driveway eventually, it might take decades to have to do that. But these larger repair expenses, replacing things like a heating and air unit as well, are not included in your net operating income. And I'm going to come back to that, why most investors do want to take those into account. And so that's why I'm going to show you another formula. It's a slight variation of the cap rate that I actually use a lot more. But the main point here is you just want to understand what all of these expenses are. And again, you can do this on the back of an envelope. You can do this on the back of a napkin to figure out what all of these are. But sometimes they do take some research to figure out what each of these can be. And it's not always on the surface going to be completely obvious. You have to do a little bit of research, but that'll ultimately tell you the NOI so that you can then figure out the cap rate. Now let me show how all this works with a basic example. So in this example, I'm going to assume that you already know the net operating income and you already know the purchase price, and you're going to try to figure out what's the cap rate on this one individual property. And this is a fairly typical scenario because you could look on the public records, for example. Let's say you're a commercial appraiser or a broker who's looking at the market. You would look at this property, you'd say, okay, I'll look on the public listings and there's a $100,000 purchase price. Got it on that one. Let's just assume this is a stabilized, already rented property, really simple scenario, no major repairs up front. And then we also could figure out the NOI. So maybe we look on comparable rents, we look on the property taxes. So you could probably figure out all of these things based doing a little bit of research. And remember, it's on a yearly basis. I don't think I mentioned that before, but the NOI is always calculated on a yearly basis for this cap rate formula. And so to figure out the cap rate, all we would do is take the NOI and divide it by the price. And so in this case, that's $10,000 divided by $100,000. And if you ran that, I keep my math simple in these examples, that is a 10% cap rate. So the way any math formula works, if you have two of the variables, you can figure out the third. So you could also, if you had the cap rate, if you knew the cap rate, and if you knew the NOI, you could figure out the price or what the value of that property should be. And that's actually how cap rates are used. I'm going to talk about a little bit more here in a second, how they're valuable and helpful for you as a real estate investor and other people in the real estate industry. But using it that way, you can figure out maybe one property like this is a 10% cap rate. But let's say there's two other properties in town, and those two were also 10%. And then you had two other properties that were 8%. So 8%, and you had one that was 9%. So you look at the collective, and this is a miniature version of what the collective values or cap rates of properties are in town. And you might figure out what the market cap rate is by looking at the average or the median of all of those properties. And so 10, 10, 8, 8, 9, kept my math simple again. The market cap rate of these 5 properties would be 9%. And so what you could then do is you now know the cap rate for the market or for maybe a particular type of property in the market, maybe all of the Class A, the best or the newest multi-unit properties in town. The average is a 9%, which is actually pretty high compared to what they actually are today. They're a lot lower with the way interest rates and the cost of money is today. But let's say they were all 9%. And if you could figure out the NOI on a certain property, you could then do the reverse and figure out what's the value for that property. You just run the formula and you can figure out the value. And that might help you when you're analyzing whether that was a property that you could afford to buy. It might help you figure out how much financing you need to get. And so this is a kind of a practical use of that, both on an individual property basis. You can run the formula, but then also there's the collective, the market-based analysis of all of the different market cap rates to get a market cap rate, and that can be very useful too. So let's now look at more of the uses of a cap rate and how you might be able to practically apply this as a real estate investor. One of the most helpful uses that I have seen other investors use a cap rate for is a measure of risk. So let me explain that. You can think about it when you see lower cap rates, and especially when you're considering market cap rates with the collective average of all the different properties that have sold in a market. The lower the cap rate is, what you can assume is that the market judges that as a lower risk. And if there's a higher cap rate associated with that area, with that type of property, or that particular property, the market has considered that to be a higher risk. If you think about and compare this to, for example, in other markets, I got this today from the June 1st Wall Street Journal. If you look at the U.S. Treasury rate over a 10-year period, these are the bonds, these are the government borrowing money from the public, and the rate of return that is demanded by the market for the 10-year Treasury, which is the lowest risk investment you could buy over that period of time in our market. That's a 1.63% return. So that's what the market demands. That's how they pay for those bonds and expect to get a 1.63% return from the interest on those bonds. But then if you look at a corporate debt, and this would be like the AAA good rated credit bonds that a corporation would borrow over the same period of time, 10 years or more, the market demands a 3.356% return on those corporate bonds. So the market perceives corporate debt to be more risky than the US government debt. And that makes sense. There's more income guaranteed by the US government. They can bring in tax revenue, they can raise tax revenue. Some corporations might go out of business. They're not as guaranteed. And so you can see there's a natural difference in the interest rate that is demanded in these two investments. And the same thing happens with cap rates. And so you can use this as a measure of risk when you're looking at and comparing different markets, when you're comparing different parts of a market, sub-markets within a market, or when you're comparing different types of assets. So for example, you might hear the term A, B, C types of properties. So if you're looking at all the multifamily property in a particular market, like within a market, some of them would be considered A by commercial investors and realtors and brokers. Those might be the brand new buildings that have very little improvements need to be done. They're in the best locations. That might be considered A, probably going to be the lowest risk. And so the cap rates are going to be lower for that type of property. Then you go to a B, maybe a little bit older, a little bit less desirable. C, the oldest or least desirable locations. And so the risk premium, you have to get a higher cap rate in order to reward you for taking on more risk. That's the way it works with ABC. You can also look at this difference between multifamily property, office property, retail, for example, in the commercial world. I got this data from CBRE. They have some great cap rate reports that I often reference when I'm trying to look these up. And 4.25%, when I looked it up today, in 2020, they had a report for multifamily property compared to office, compared to retail. And you can see the difference. The market perceives multifamily residential to be less risky than office and less risky than retail. But retail they perceive to be a little bit less risky than office. Perhaps that's 2020. We were in the middle of the COVID recession. That could play a part in that. Office there's some issues with people. Are people going to be going back to offices? So these things fluctuate, and this is the value of it, though, is a measure of risk. And how can you use that as an investor? Some of it you can just study the market and notice that and say, what type of investments am I willing to buy? But also we as investors, kind of like Warren Buffett talks about value investing, we're looking for little pockets of opportunity. We're looking for places where maybe the market values it at one way, but you perceive it to be a less risky bet than the market does. Maybe you notice something about office rentals in a certain location. You have more information about what's going on in that market. And this is the beauty of real estate investing. There is not a perfectly efficient market. And so you might find pockets of opportunities there where you're willing to take a risk and you're willing to maybe make a higher return as the market corrects itself and maybe gives that a different cap rate. Maybe the cap rate goes down, so the values go up. And so that's the point, is that you can use it as a measure of risk. You can also use it to understand where there's some pockets of opportunities, both within markets and also comparing different markets. The higher tier markets, buying in Manhattan or in LA or San Francisco, Atlanta, some of these bigger markets. The smaller markets, the smaller cities typically have higher cap rates. But if you really understand that small city and understand the economics and have a long-term conviction that it's going up, you might be able to make money from some of the lower price markets that have higher cap rates. And that's what a lot of real estate investors are doing today in particular. So let's now go to one other use of how you can use a cap rate, and that's more in the valuation of a property. Remember when I first unpacked the formula for cap rate, I mentioned that one of the techniques you can use it for is valuation of a property, figuring out what the value is. And there's actually a commercial technique called direct capitalization method. And I'm just going to explain real briefly how that works, and then I'll go on and give you an example of how we can use this to make money as a real estate investor. So just to review though, if you have the NOI, if you know that number, you can figure it out. And if you can figure out what the market cap rate is by talking to brokers, talking to appraisers, let's say you know that $10,000 per year is the NOI, and there's a 5% cap rate for this type of property in this market. You would just reverse the formula. So instead of figuring out what the cap rate is, you're going to try to figure out what the value is. And so NOI divided by cap rate equals value, and $10,000 divided by 5%. And this very simple example is $200,000. So that's the simple application of the direct capitalization method. But now let me show you an example of how this is practically helpful when we're going out and we're analyzing investments to figure out how much money we can make. I want to give you a fairly typical example of where cap rates come into play for you as a real estate investor during a deal that's called a value add. And what this means is you're doing something to the property. You're either improving it through repairs, through increasing the rent, through reducing the expenses. And so any property where the value is dependent on the income, if you increase the income or decrease the expenses, you're going to increase the value of the property. And we're going to assume in this case that the constant cap rate, so the cap rate's the same in the beginning and the end of your deal. And so let's say you buy a 4-unit property, a 4-unit apartment rental for $500,000. You put $150,000 down. That's about 30%. That is 30%. And you're going to have to get a $350,000 mortgage. We're going to have a $25,000 per year upfront net operating income. So that's how the property was performing when you first buy the property. And so let's figure out what the cap rate is. We actually bought it at the market cap rate, but the NOI divided by the price equals $25,000 divided by $500,000. So that's a 5% cap rate. And some people might say, oh man, that's not really that great, is it? Don't people want to make a higher return than 5%? Well, let's actually see, how can you make money on a 5% cap rate property? So let's say 2 years from now, you did some things to the property, you increased the value, you spent about $50,000 in some repairs that allowed you to cosmetically make it look better, to turn it around, to attract different tenants. And you were able to increase the rent and maybe decrease the expenses a little bit in order to increase the NOI, the net operating income, from $25,000 to $35,000 per year. So that was the value you added to the property. So now let's look at what the cap rate is the exact same. The NOI divided by the cap now is $35,000 divided by 5%. And so the new value is $700,000. You paid $500,000, it's now worth $700,000. And so if you, let's say you sold it, and let's just simplify things, you didn't have any closing costs, which you probably would, but let's just say $700,000 minus the $350,000 in debt you had to pay off. Let's just say you had the same amount of debt. You would have a return of $350,000. So you're getting your down payment back, you're getting the $50,000 repairs, plus you're having a gain on that property. So you invested $50,000, plus you had $150,000 down. So that was the cash you invested. So you had a $200,000 investment and you got a $350,000 return. So you've not quite doubled your money, but in 2 years, you've almost doubled your money, and you've made a lot of money on a property that had a 5% cap rate. So your return, your actual return, is much more than the cap rate, but you're making your money by increasing the value, and you're using the cap rate to help you figure out what that is. So that's one example, but let me show you another example where let's change things up a little bit. Let's say that the cap rate isn't constant. Let's say the cap rate actually goes down over a longer period of time, and let's see what that does to an investment deal that you're analyzing. In this variation of the example, we're going to do some things very similarly. You're going to buy the same property for a 4-unit for $500,000, put $150,000 down. The NOI is $25,000. The cap rate's 5%. The difference is going to be that between the time you buy it and when you sell it a couple of years later, the cap rate's actually going to go down. So the market cap rate does fluctuate. And I'll talk in a second about how that might happen or why that might happen. And you may or may not predict this is going to happen, but let me show you what would happen if you do the same improvements as before, but you also have a falling cap rate. So you improve the property from $25,000 in net NOI to $35,000. But this time the cap rate that you're using to value it is 4.5%. And this is called an exit cap rate, by the way. So when you're exiting the property, sometimes the cap rate could be different. It could be lower, or I'm going to show you an example next where it's actually higher. And this can impact in a big way, the profitability of your investment. So in this case, I'm assuming the exit cap rate is 4.5%. And so $35,000 in NOI divided by the cap rate of 4.5% gives you an exit value of $777,778. So we have a mortgage of $350,000 we're assuming again. And so our net return at the closing is $427,778. And remember, we spent $50,000 in repairs and $150,000 down. So we had $200,000 invested, and just a couple years later doubled our money and more, $427,000 back. So you can see, especially using leverage, when falling cap rates happen, you can make a lot of money. And this is something you want to be careful of when you're buying properties yourself or you're investing with other partners. You really want to look carefully at what that exit cap rate is. It's easy to juice your returns to make it look like a much better deal by showing that cap rates are going to go down. But what happens in the other case, and you want to think about worst case scenarios when you're buying an investment property, you don't want all of your returns to be dependent on something you really don't have anything control over. I mean, it is possible. And why would cap rates fall? Maybe Amazon moved into your market and you had a clue that that was going to happen. And therefore, this became a much stronger market because the job market got better, the demand for your rentals got better, and maybe the rents were going to go up. Maybe all of a sudden you're a lower risk market, and that's why that happened. But the other thing can happen too. An employer might shut down. Something might happen to the overall market. Interest rates could go up. And interest rates, while not completely directly correlated with cap rates, are very closely correlated. And so if interest rates went up, the cap rates might go up as well. So there's a sensitivity in deals like this where you're adding value to the exit cap rate in particular. And so you want to be careful on one way or the other that it can cause you to gain a lot of value because of the falling cap rate. It can also cause you to lose some value. And I'll show you real briefly what that would look like if the cap rate actually went up. So in this example, we're going to talk about what happens if we have rising cap rates and how that affects the value. It actually makes it fall. So if we buy this 4-unit property for $500,000, same thing, we put $150,000 down, the NOI is $25,000 per year, and the market cap rate is 5% when we buy it. We're not going to do anything to this property. It's just going to be a buy and hold instead of adding value to it, just to show you what would happen. So 2 years later, let's say the exit cap rate goes up. The market cap rate, for whatever reason, maybe interest rates rise, maybe somebody goes out of business, then the job market in your market, whatever happens, there's some negative news for your market and people demand a 6% cap rate instead of the 5% you bought it at. So nothing's changed on the overall property. You still get the $25,000 in net operating income, but the cap rate is 6%. So your value now is $416,667. So less than you bought it for. So what does this mean? If you were to sell it at that point, or you've just analyzed what your net proceeds would be, $416,667 minus $350,000 in debt, you paid your debt off, you have a $66,667 return, and your investment was $150,000. So you have less remaining in equity than you had 50% less than what you started with. And that is how leverage cuts both ways, particularly when you have falling cap rates. Now, it hasn't happened in a while. Rising cap rates, where we've had rising cap rates and falling values. But as an investor, you got to think about all different scenarios, what could happen, whether that's my local market, or whether that's the overall market. We've been in a falling interest rate market for a long time, and maybe that'll keep going for many years. But you do want to understand the dynamics when you're analyzing income property, and the cap rates help you to figure out what those different scenarios are. You can run all these scenarios on the property and say, what would happen if an interest rate rose from 5% to 6%? How would that affect my value? How would that affect my assumptions? And would I still be happy investing in this deal at that point? And so that's what I want to transition to now. We've looked at some of these examples of cap rates. I want to go to a slight variation of the cap rate and more give you a perspective on how I use this variation to analyze my own deals to make sure I'm happy with them and I'm analyzing them accurately over the long run. So we've gone over a lot of details of cap rate, the formula, how you use it, different examples. But what you might hear yourself asking, and I've been guilty of this as well, is to ask the question, what's a good cap rate? How can I use this as a goal in order to buy a property? And the question is not actually a great question. And there's a better question you can ask, because remember, cap rate is a way you can value a property. Cap rate is a way that you can measure risk. And so that's not necessarily the same as asking, how can I make money on this property? That's the better question for you and I as investors. And so I just want to remind ourselves of the ways we typically make money with a real estate investment. We make money on the price, we make money on the income, the amount of rental income we get coming in. The price, we've shown in some of the examples, if you buy a property at a 5% cap rate, and even if the cap rate doesn't change, if you can increase the NOI, if you can add value to the property over the short run usually, so it's usually in like a 6-month period to a 5-year period, you add value, that's a tried and true way to make money on the price. And you increase the price and make the margin. Hopefully you're spending $1, making $2. You can also, with long-term buy and hold, find locations that are quality locations where there's going to be increasing demand over time, maybe a limited supply of housing. And so those long-term buy and hold maybe you buy it at a lower cap rate, but maybe the growth of the income and the growth of the market outpaces a lot of other places. And what started off as a 5% cap rate might be a lot better return later on. So that the 5% doesn't necessarily tell you how much you're actually making on a really good long-term buy and hold investment, particularly with leverage. So those are two ways you can make money on price. But then we also, of course, do make money on rental income. And I find that to be, even though you can make really big money with a price, the income is really the engine of everything else. It allows you to hold on long-term buy and hold properties. It allows you to get to the profit on these value adds. And a lot of things have to work right on timing of these price type properties. These are much more speculative than just getting income and either putting it in the bank account or using it to pay your debt and amortize your debt. And so the income is super important. So it's tempting to sometimes say the cap rate is a goal that you want to have because it is a rate of return on the income for the property. But there's a little bit of a variation that I like to use, and I'm going to go over it now. It's called a rental yield. And so I want to tell you what the difference is between a rental yield and a cap rate and how I use that as one of my most important formulas that I have when I'm buying a property. This variation of the cap rate is called an unleveraged rental yield, and it's actually very similar. The main difference is that there's capital expenses taken out of the net operating income. So what you're trying to do is get to an actual economic cash flow number. So all of the money that you might spend on an annual basis, what is that? And so the NOI is part of that. You want to take all of your operating expenses from the rent, but you also might spend money on some reserves for future capital expenses like replacing the roof, replacing the driveway, replacing the heating and air, for example. In some commercial contexts, you might also have some money spent on tenant improvements. So yes, those are actual things that come out of your bank account. So you would want to account for those when you're actually analyzing a property for yourself. But just like cap rates, use the total investment. We're not talking about cash on cash return. We're not looking at any kind of debt involved. We're looking at the unleveraged yield. So you take this real cash flow that you're going to make on an annual basis and you divide it by your total cost. So again, the main difference here, look at the formula from cap rate, is NOI divided by the price or the value of the property. And so in some cases, the total cost, like when I run the cap rate, I actually include the total cost. So that might just be the same there. But the big difference is not including CapEx in a cap rate analysis. So this is helpful because you can look at a property and you can make a goal to say, I want to make a certain unleveraged rental yield because that's really the engine for what's going to drive paying for your debt. You're going to use it for cash flow. It's the thing that gives you staying power when you buy a property. So this isn't the only goal I have. Like if I'm looking at a property, it's almost like a dashboard on an airplane. You have several different gauges that tell you, hey, I've got this much gas in the airplane. I've got this much altitude. I'm going this fast. And just like that, when you're looking at a deal, you want several different formulas to help you tell yourself whether this is a good deal or not. And an unleveraged rental yield, for me at least, is one of those key components. That's one of those key things you want to look at. And I'm going to now show you an example of how you might use unleveraged rental yield in a real property, and then compare that with that property, what cap rate would look like. Here's an example how I might use rental yield on a real property. Let's say I'm buying a house, or a fourplex in this case, for $400,000, and I'm going to put $50,000 in repairs and cost in order to see some potential to increase the value, increase the rents of the property. So I have a total cost of $450,000. So let's look at the scenario as I started and the scenario after I'm done stabilizing the property, adding value to it. So the $36,000 per year was the current rent, $3,000 per month. I had operating expenses of $14,400. I had capital expenses of $1,800 per year. So that's setting aside money for heating and airs, for roof, for things like that. So I have $19,800, and I put NOI, but you could also maybe more technically call that something like a cash flow from operations, just to differentiate that by the fact that I'm including CapEx. Call that a cash flow from operations. And so my cash flow from operations is $19,800. And when you divide that by my original purchase price, $400,000, that's the pre-scenario before I did the repairs, I had about a 4.95% yield. And you can actually compare that to what it would have been running a cap rate. That was 5.4%. So that was just including deducting the operating expenses, not ignoring the capital expenses. So you can see there's a difference there. And this is why it's more accurate for you as an investor to understand what the rental yield is when you're trying to really run your numbers. Now the after effect though is that I have $48,000 in rent, $19,200 in operating expenses, and $1,800
per year in capital expenses. So I have $27,000 per year in cash flow from operations. Divide that by my total cost, $450,000, and I get a 6% rental yield. Now, why is this number important? Why is this helpful? Why do I want it to be one of the filters on my dashboard of my airplane when I'm looking at my rental properties to buy them? I'm also going to look at internal rate of return. I'm going to look at some other metrics, but I really like this metric because this is the bottom line of telling me what this property can afford to pay me from a cash flow standpoint. And so I can look at it and say, well, if I wanted to borrow money at 6% interest from a private investor, if that's just how I wanted to knock this deal down, I know that this property produces 6%. And so if I paid interest only 6% to my investor, I could barely make that payment, or at least I could kind of keep afloat. If my interest rate was 8% and I was getting a 6% on this property, I'm losing money, and I would be losing cash flow in that case. And so this is really about your debt coverage and making sure you're having some positive leverage. I think over the long run, this is what allows you to have a stable property, allows you to keep the property and hold it for the long run. If your cost of capital, in this case, your debt cost, in some cases, this might be your equity cost. You might have partners who want to make a certain yield on their money. By knowing exactly what you're going to be yielding, you can know how you can distribute that to the people like your debt, your lenders, like your equity partners. And so you just want to be realistic about that. And this is the number that allows you to do that. It's not your ultimate return because you can have other ways of making money, as we've explained, your price increases, amortizing your debt, things like that. But this is really an important metric, and I find even more helpful than a cap rate, although you can use both of them as we've demonstrated in this video. We've been through a lot of numbers, a lot of examples in this video. So I just want to sum this up by saying cap rate is a useful tool that if you want to measure and compare risk of markets, risk of different properties, it's an excellent tool, kind of like comparing risk between treasury bonds and commercial bonds on the open market. You can compare different real estate using this tool called a cap rate. It's also very helpful as an investor to get the value of an income property. So if you want to figure out what the value is today based on the market cap rate, and if you want to figure out what the value could be after you do something to the property, like increasing the net operating income by either raising the rents, reducing the expenses, or both. So it can be a very helpful tool to figure out how much profit you're going to make on an income property. But I also wanted to add, and we went over at the end, that if you're doing an income analysis to figure out what you're really making, the ratio of income to your total cost, a better formula is a very close cousin of the cap rate called an unleveraged yield. That's what I use in my own analysis of investments. And then I'll also add, and we didn't go over this in this video, but an even better, more comprehensive return on investment analysis would be from something called an internal rate of return. It takes into account the income, takes into account the increase in price, any amortization of your debt. So it's really kind of an all-encompassing way of looking at the discounted value of all of the cash flows into the future. And I'll do a video in the future on that. Let me know in the comments if you do want me to analyze IRR, internal rate of return, and show how to do that as well.
Do you use cap rate as a real estate investor? And if not, what other formulas are more important to you with your real estate investment analysis? I'd love to hear from you in the comments below. And if you like this video, be sure to hit the like button to help me spread the word on YouTube. If you're new to this channel, be sure to hit the subscribe button and the little bell so you don't miss anything. I have new videos that come out every Friday morning. If you like this video about analyzing properties and running the numbers, I think you'll like my next video, which is an analysis of 17 years after my first real estate investment. And I go in depth both with cap rates and kind of basic analysis like this, and also a spreadsheet where you can see year by year how my property did, what kind of internal rate of return I got over the long run. So you can kind of see the full analysis of a property after the fact. And this is my very first rental property that I bought early in my career. So check that video out. The link will be in the video description below. You've been watching Coach Carson TV. My name is Chad Carson. You can also call me Coach. And this is a channel all about investing in real estate, achieving financial independence, and doing more of what matters. See you next time.